Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and this is the 23rd day of August 2016. I like to remind you each and every week that I'm also the author of a newsletter, Jay Taylor's Gold, Energy, and Tech Stocks. And my company, Taylor Hard Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying and What is Chen Selling. And we are going to actually have Chen with us in the second segment of today's show. He'll be talking about some of his top picks as well. Now, just to sign up for Chen's letter or mine, go to miningstocks.com, and it is a most exciting time. Really fun to do what I do again, write my newsletter about mining stocks, especially the exploration stocks. And my personal top pick is up more than 24% today, at least it was before airtime. And that is Quinton Henning, Dr. Quinton Henning, who's been a guest on this show a number of times, who's in search of the next Witwatersrand deposit in northwestern Australia. He may be on to something very, very big. Certainly the action of the stock today suggests some people think so. And, I have thought so for some time. The prospects of something very significant taking place with Dr. Quinton Henning's theories and the results that he's gotten so far from his exploration efforts. We'll be talking to Dr. Henning sometime in the near future. Do want to encourage each of you to send along your questions, comments, criticisms, and praises to questionsfortaylor@gmail.com. And we do want to thank our sponsors for making this show economically viable. Our sponsors for today's show are Trimetals Mining, Coral Gold Resources, New Legacy Gold Corp, Brazil Resources, Columbus Gold, and Aran Resources. We do have a very busy day today, so let's get right to it. I've named today's show, Why Does the Fed Persist with Failed Policies? Now, Ms. Shedlack was going to be my main guest today, but when I learned yesterday that he was not going to be able to make the show today, I was really lucky to get with me once again John Rubino. He had been with us last week. Well, if there's any guest that I know of, any person that comes on this show who on very short notice could very quickly answer the questions posed by Ms. Shedlack, it would be John Rubino. So really happy to have John Rubino of DollarCollapse.com with us today. And also we're very fortunate almost every week to have Michael Oliver with us. And right after Michael, Chen Lin will come on to talk about a couple of his favorite biotech stocks and energy stocks. And I think Chen will have a thing or two to say as well about gold. But now, Michael is with us. Thanks for joining me again, Michael.
Great to be back, Jay.
Always good to talk to you because you sort of keep me comfortable in a sense that I feel comfortable in terms of if I'm on the right side of a market, not from a day-to-day perspective because I'm not a trader, but as an investor. So I'm so appreciative of you being with us. Your work, you talked this past weekend. You've been talking about the T-bond, which I think is beyond a doubt the most important market in the sense that the United States dollar is still the reserve currency, very, very important. And you had mentioned in your weekend missive, it's some colorful language, which makes your reports very interesting, I must say. For a technical analyst, you're really a lot of fun to read. And in your weekend missive, you talked about the T-bond tiptoeing near a minefield of downside trend. And at around noon today, the T-bond was unchanged at around 172 and 12/30 seconds, somewhere in that range. At what price is your momentum work telling you now is sort of key for the T-bond? Where do you think we're going to hear that whoosh sound?
It's a range, and by a range I mean that if I look at various momentum trend indicators of the T-bond futures, for everything from intermediate trend like a oscillator that measures T-bonds versus a 10-week average, for example, which is like measuring it versus a 50-day, or let's say I measure it versus a 3-month average or a 3-quarter average or 3-year. Each of those measures T-bonds on a larger and larger scale. It's like having a microscope. You change the lens, okay? And each of them has their own statement to make. One of them, the more short-term, obviously, will flip-flop more often because, short-term trends go up and they go down, they go up and they go down, all within the context of something larger. But right now there's a cluster of numbers that starts roughly around 171 on a weekly closing basis. Now, I had that a week ago for my subscribers. I said if we'll close this week out at 171 or lower, that's negative for the first of these upper end of the range minefield numbers, okay, that start something bad. Well, we traded under 171, closed out the week at 171 and 3/30 seconds. Saved by the bell. And then today traded all the way up to 173 on the T-bonds. Like, oh boy, I got right near the cliff, looked over and pulled back. The problem is this for the T-bonds. Whether they hold these numbers for another few weeks, have another rally, it doesn't really matter to me. The numbers are definable. They're in a zone of about 5 points width, starting 171 on down to about 166. You go through all those numbers, it's over. The whoosh starts at the lower end of the box, of the minefield. Once you start tripping into the numbers, one indicator is going to flip negative, let's say an intermediate trend. That's like a push, like a little domino. It falls.
Yeah.
It's a little larger domino. And the next larger, you trip all the minefield, boom, you're gone. It's going to happen. I'm confident the T-bonds will top and collapse once they've topped. I think the top is probably near. We may have already seen the top tick. But the issue is the downturn, triggering those numbers. And I urge my subscribers when I make these points about big trend changes in this market or that market, don't get all excited. Be patient, wait, let the numbers tell you when. Because if you're too eager and you establish a position too early, you might get killed and then be right. And the better thing to do is miss a few points and be right. Know you've got the wind at your back. Right now on the T-bonds, I'm confident they're going to collapse and rates are going up. Probably you'll see the evidence this year. Big time. But the trigger point has not been hit. We're dancing on top of it. This is also true with the Japanese government bond. So I'm watching a lot of things in that regard.
Right. The three sovereign risk bonds, the German Bund, yeah.
Correct.
Those three will go together, as you said before.
I think they'll go together. Yes.
Yeah. Right. All right. So if we're going to see rising interest rates, what might that portend for commodities?
I think the commodities are poised equally and opposite the T-bonds. Although my confidence that I use the Bloomberg Commodity Index. It happens to be a well-balanced index. It used to be the Dow Jones UBS Index, and then in 2006, I think Bloomberg bought it. It's a good metric of the commodity basket. It doesn't overly weight energy like the Goldman Sachs Index, for example. So gold and silver are a certain percent, the grains are a certain percent, meats, oil, the whole deal. It's a good index. I like it. It is poised for a major breakout on annual momentum. You cannot see it on the price chart. The price chart looks like, it's upticking a bit, big deal.
Yeah.
The annual momentum chart says it's explosive. And right now it's at 86, just above 86. You close out this month over 87, it's going up. You close next month out about 86, where you are now, it's going up. And I think you could get a surge in the commodity basket. Gold's already underway, of course, we know that. So is oil. But some of the commodities aren't yet. And when you move the BCOM as its symbol, the Bloomberg Commodity Index, out above these numbers that I've pegged, I think you could get a 20% surge within a quarter or two.
Wow.
And that would go with a T-bond decline. In other words, you're getting inflation. They want it, they're going to get it. And they're not going to get it where they want it. They're going to get it in the assets they don't want it in.
And they might get it more rapidly than they want. Michael, with just a couple of minutes left, I have to ask you a very interesting comment you made about gold. You said whenever gold stalls, gold longs, the bulls are always concerned that a meaningful correction is coming. And then you said their gains, especially in gold stocks, are so vast this year that gold longs are beside themselves with desire to protect something they haven't seen for a long time. Well, you don't seem to be concerned about any serious correction on the downside. Why not?
Well, we just had, as far as I'm concerned, a correction involves double-digit percent, 10, 15% at least. We just saw an 8% drop in gold during the month of May from the 1306 high down to 1199. Took out the two lows of April, the lows of the month of April and March, thereby scaring the price chart, folks. This is the start of a major decline because you took out two prior months' lows. Yeah. We thought it would stop in the 1190s. It did. 12 trading days later, you were well above those highs. You were in the low 1300s. Why did we stop at 1306 at the May peak? Because the high tick of 2015 was 1307. So some Johnny with a nickel in front of a freight train thought he could sell gold, make a buck. He did. He made $100 and some if he was smart and got out. But 12 days later, it came roaring back through that. And we just had an 8% correction in the May collapse, which 8%, if you call that a collapse. It was a correction, a mini correction, I called it. Why now that we've just blown through that shelf of price resistance, the 2015 high and the May 2016 high at 1307 and 1306. Why now in the lower part of the 1300s should we have another correction? It makes no sense to me. I have no technical evidence of a correction coming from
Well, that's very interesting. I think you just really spelled out why I like your work so much for my purposes, Michael, not as a trader, but as an investor. So, we'll let that guy have that $100 if he was absolutely perfect in picking a timing. Yes, if he got it. But, I'm looking at companies that are developing resources in the ground that have been there for millions and millions of years, and now they're about to bring them out. And with the gold price where it is, as long as we don't have anything catastrophic on the downside, I'm very pleased. And I think you see a lot of upside here yet before gold enters any serious resistance still, right?
Yeah, I still think the upper 1400s, low 1500s. At that point, then maybe you can get a little itchy about what you could call a correction, meaning something of a double percent nature, 10, 15% pullback. At that point, I would get more itchy. Right now, I think itchiness is not a good idea. In fact, it's likely to shake you out of your position. And that's happened probably a couple times with most gold investors over the last 6-7 months. They've probably been shaken out twice, 3 times because they got scared.
Well, I can tell you that I don't know how many technical analysts that I pay some attention to that have been very nervous about it. So you I think you hit the nail right on the head. A lot of nervousness.
I could always be wrong, but I don't think I am. I think it's still solid, and there's more to go. I will say this: you get up into 1370s again. We've been above there, by the way. You're gone. I think they'll pack another $100 on very rapidly. So
that's that whoosh.
Anywhere near those highs that we.
That's
just
that
made.
whoosh point we're looking for. The whoosh point
Yes.
That the bulls are looking for. Anyway, all right, Michael. We have to leave it there because that's all the time we have. Thanks so much for sharing your time and insights with us. Greatly appreciated, and we'll look to do it again next week, hopefully.
Thanks, Jay.